Hey, good afternoon, folks. I hope you enjoyed that terrific slideshow. I'm Luke Swetland with the Santa Barbara Museum of Natural History and Sea Center. I'm delighted to welcome you to this, our third Lunch and Learn webinar of 2024, presented by the museum's Plan Giving Advisory Council. You know, for over 100 years, the museum has been able to offer free community education like this today at no cost. And today's Lunch and Learn is going to focus on real estate law and taxes. That's a lot of ground to cover. We have a couple of great speakers to do that. You know, folks, supporting a good cause or an organization through an estate gift is a wonderful way to marry your legacy to something much bigger than yourself. And it helps that organization or cause continue to do its good work. I hope you'll consider the museum in your estate plans and help us ensure the future of this great institution. Before we get started, I just want to give a shout out to 5 amazing things that will be happening this fall at the museum and the Sea Center. First, our planetarium will be back open next week with those amazing high definition, high resolution projectors. So come by and see a planetarium show. For the first 2 weeks in October, we'll have the Artist Table Art Show hanging up, and all that art is for sale. Half of the proceeds benefit the museum. In the middle of next month, we're opening a new exhibition in our Maximus Gallery called Big Cats and Wild Dogs. So that'll be fun. And then we have a mysterious exhibition called Fashion Fatale, which will open in mid-November. I'm not going to say anything more about that, but I've seen all the mock-ups. It'll be terrific. And finally, at the end of this year, Curator Emeritus Jan Timbrook will be unveiling an exhibition of Chumash baskets in our Chumash Life Gallery. So there's going to be a lot of things to come and see at the museum, and the Sea Center is always a magical place. Always good to go down there and get your hands wet and see what's happening in the channel. So I look forward to seeing you all. Check out the website, sbnature2.org, for details and particulars about all of our offerings. And now let's get to our business at hand. And for that, I'll turn this over to my colleague, Andrea McFarling. Andrea?
Good afternoon. Hi, I'm Andrea McFarling, Santa Barbara Museum of Natural History's Philanthropy Officer of Legacy Giving. We are happy to share with you this free webinar with helpful information on real estate law and tax essentials. Today's webinar is presented by our good friends Chris Jacobs and Tiffany Goodall. Time has been allocated at the end for questions. Please place your questions in the chat, which you should see at the bottom of your screen. If you have any technical issues during today's program, please email Robert Shutt. This email will be placed in the chat. We will be recording the webinar, and it will be available on the museum's YouTube channel in a couple of days, so look for that. Feel free to reach out to me if you have any plan giving questions or need more information. I'm here to help you leave your legacy, and hopefully you will keep the museum in mind in your planning. Now I'd like to introduce our 2 speakers, Chris Jacobs and Tiffany Goodall. Chris Jacobs is a shareholder with Brownstein, Hyatt, Farber, Schreck, LLP. Chris's practice revolves around complex real estate transactions, real estate finance, title insurance, development construction, and land use matters. With a background that includes substantial and firsthand experience in general contracting and real estate development, Chris has a thorough understanding of the business and legal issues affecting real estate and real estate development transactions. Working with a diverse client base, Chris analyzes transactions from a multitude of perspectives, providing his clients a comprehensive legal approach to real estate and land use matters. Chris served on the museum's board of trustees from 2004 to 2009, serving as board secretary, as well as on various museum committees, including master planning. Tiffany Goodall began the first decade of her career in managerial accounting, managing both a law firm in Los Angeles and then a multi-million-dollar legacy winery in San Ynez. Tiffany works remotely for Calegari and Morris, a mid-sized CPA firm based in San Francisco that has been around for over 92 years. Her focus is high net worth individuals, trusts, and estates. She loves to help plan gifting strategies, whether for the next generation, charitable legacies, or both. Tiffany and her young children love visiting the Natural History Museum and Sea Center, and she is so happy to give back to the community and the museum by presenting to you today. Chris and Tiffany, thank you so much for speaking with us today. I turn it over to you.
Welcome to my world, everyone. Thanks for joining in this morning. I love real estate. Right now, I'm sitting in my office, second story building, overlooking. Let's see, I'm looking out over American Riviera Bank, looking at the courthouse and the mountains beyond, palm trees, banana trees, magnolia trees. It's a pretty fantastic morning, and everything I see is all real estate. If it's attached to the earth, it's generally considered real estate. And we've got a lot to cover. I have done sort of a stream of consciousness outline and presentation, which I hope you will enjoy. I've tried to hit things that I think are going to be of interest to people. So it's not in any particular formal order. Starting out with home ownership and why it's the American dream. Well, to start with, real estate is a limited resource. They're not creating any new real estate. And so it has high intrinsic value. It also is very flexible in terms of use. So particularly with residential development, you have a beautiful home to live in, together with it being an asset which generally appreciates and has a very low downside investment risk. Real estate can also be important in terms of securing other types of borrowings, because it is generally considered to be a very stable asset. And in addition to its utility, lots of people have great pride of ownership in their property, whether it's residential or commercial. Additionally, there are significant advantages in real estate as an asset for purposes of intergenerational transfer of wealth. Now, some of those estate planning concepts of using real estate have changed and will change, and that's something that you have to count on, that tax laws are constantly changing, and so a estate planning strategy that may be viable today might not be viable in 5 or 10 years, maybe not even 2 years. Tiffany, could you go to the next slide, please? When people are looking at real estate, location is generally the most important factor. Obviously, you have to find a real estate investment that is within your budget range. You know, you can afford it. You can afford the mortgage payments if you're going to have a mortgage. You can afford the insurance payments. You can afford the property taxes. Insurance and property taxes we'll be talking about in a little more detail further on in this presentation. You know, you generally want to find something that makes sense for you, whether it's proximity to work, schools, family, or friends. One thing that is usually considered is whether it's best to buy the best property in a less desirable neighborhood versus the worst property in a more desirable neighborhood? I would say generally you want to get the worst property in the best neighborhood that you can afford. So I'm going to cover sort of the basics of the purchase and sale process. In our market, California, almost all real estate transactions use documentation, purchase and sale documentation, that is created by the California Association of Realtors, or the CAR. It's genuinely good documentation. There's nothing wrong with it. It's pre-printed, but it's just excellent. And when I first started practicing law about 35 years ago, we sort of scorned the use of CAR documentation. And in a lot of real estate transactions, I remember when I was starting, it was if the transaction has a value of, say, more than $1 million, then we don't want to use CAR documentation. We'll use regular attorney drafted one-off documentation. That's not the case anymore. You can see California Association of Realtors documentation being used in transactions that are multi-million dollar, $50 million, $100 million. It will have the CAR purchase and sale agreement, but attached to it will be an attorney drafted addendum, that's a very important element of the transaction. Now in California, all sales of existing homes are as is. So there are no warranties, and except for new homes. And in our market, Santa Barbara, Montecito, Hope Ranch, there really are not very many new homes that are on the market. So you have to assume that you're purchasing the property in its present condition, which means that you need to do due diligence inspections. And I've listed some of them here. That obviously you're going to want to make sure the title is good. You'll do a physical inspection. Those are usually done with a home inspector. Termite reports, microbial contamination or mold, geology, and survey to potentially determine if there are boundary encroachments. And you would also probably like to take a look and see if there's permits that have been issued for the improvements that are on the property. There are seller disclosures, which are required by law. It's referred to as the TDS, or the Real Estate Transfer Disclosure Statement. And in that, the seller of property is required to disclose issues that the seller is aware of that might affect the desirability or value of the home. For example, have there been floods in it? Has someone died within that home within the last 3 years? Have there been any landslides? So there is this requirement that sellers tell what they know, but that doesn't eliminate the buyer's duty to conduct reasonable investigations. Tiffany? Once you have gone through the purchase and sale process, you've made your determination as to going forward with the acquisition, then you have to decide how you're going to take title to the property. And that is potentially a significant decision. A lot of times people will take the property in their own names. You know, it will be John and Jane Smith, if it's a married couple, as community property. It could be in joint tenancy, but particularly in our area where property tends to be high value, you'll find that the majority of people have revocable trusts, and most of the properties are held in the names of the owners as trustees of their trust. Those are trusts that are very flexible. They can be revoked at any time, and they can be amended at any time. And typically, the trustees of the trust are the beneficiaries. Now, there's other possible beneficiaries. There's ultimate beneficiaries, such as the owner's children, probably. Or there could be other beneficiaries, such as the Natural History Museum. And we have had some very generous folks in our community who have named the Natural History Museum, and they also name other charities, obviously, as beneficiaries of their trust. I'm pleased to report on one transaction which we had last year, in which we received a donation of a home in Hope Ranch, and we were able to sell that home without doing much work on it. We just cleaned it up. It was in a desirable neighborhood location, close to Laguna Blanca School. And it turned a very nice profit, which went to the museum. If the purchaser of the property is an entity, then it will probably be taken in the name of either the corporation, the limited liability company, or a partnership. Next slide. Insurance is important. The first type of insurance that you'll come across in property ownership is the title insurance. And title insurance is something that is offered where an insurance company assures or provides insurance as to the seller's ownership of the home. So does this seller actually own title to the home, and are they able to convey it? And if they convey it, what is the conveyance subject to? So the title insurance company issues something called a preliminary report. And in the preliminary report, it specifies who the ownership is in, and it lists the items which may be exceptions to title, such as there could be judgments, there could be liens, there could be deed restrictions, there may be CC&Rs. And there are various forms of title insurance. Probably don't have time to go into those details, but they do offer excellent coverage. They cover the fee ownership of the parcel, the ground itself. They insure your access over easements, and the coverage amount of the title policy is the purchase price. Different than other types of insurance, a title insurance policy lasts for so long as you own the property. Claims can be made against the title insurance coverage if you find that the title insurance company missed something on issuing their preliminary report, and it turns out that there was a judgment, but the title insurance company missed it. Then the title insurance company has to solve that problem. In looking at title insurance companies, you want to pick one that is probably a national company that's been around for a while, and so that you can be confident that they will be there should there be a claim. Other insurance that is needed is a homeowner's insurance, and particularly if the property is financed, if there's a mortgage, then the lender is going to require that you have property insurance. It's a bit of a problem right now because property insurance is difficult to obtain in certain circumstances. For example, if you're in a high fire risk area, which is substantial portions of our county, it's becoming very, very difficult to get homeowners insurance. And that has had an effect on the market, which has tended to somewhat depress values of very expensive homes because the cost of insurance becomes a real major factor. For example, on a $10 million house in the hills of Montecito, you might be looking at property insurance that would be $300,000 per year, as opposed to a year or two ago where it might have been $35,000 or $40,000. There are exceptions to what homeowners insurance covers. It doesn't cover floods. It doesn't cover earth movement. It doesn't cover earthquakes, mold. Doesn't cover negligence, intentional damage, or extended vacancy if the home is unoccupied. We've discussed this a bit, which is the market is in turmoil. And the fallback to limited availability is an insurance plan called the California Fair Plan. It's an insurer of last resort. It is a pooled insurance company, which the insurance companies all participate in, but it has limitations as to the total amount of coverage. I believe the current amount that is maximum is approximately $3 million. Property taxes. We're going to speed through this. California has a constitutional amendment, which is referred to as Proposition 13, which says that the assessed value of your home is based upon what you paid for it, and the county is able to increase that amount by approximately 1% per year. So it's a very odd circumstance where you may have somebody, I'll say, take my mother, who has a very modest house, but it is on the beach. And she purchased it in the 70s. So she has a very low tax basis, and her neighbors who purchased last year are maybe paying 50 times as much in taxes as my mother is paying. So is that fair? It's been tested and under the Equal Protection Clause, and Proposition 13 has survived those types of challenges. There are exceptions. Every time a property is sold, it's reassessed. So one of the estate planning strategies that was used for years was an exclusion from reassessment, in which a parent transfers property to their children, and their children maintained ownership of that property, and they paid the same amount of taxes that their parents paid. So that is no longer the case. There's something called Proposition 19. It applies to residences only, and both the transferor and the transferee must use the property as their principal residence, and the exclusion amount is only $1 million. So that's a big change, And this is an area of law which changes rapidly. The other type of transfer or incidence of property tax where you sometimes get a benefit is another provision in Proposition 19, which pertains to transfers of value of people that are over 55 years of age. And they can take their low property tax basis with them anywhere in California now to another home. And it can be in any county. It used to only be if it was in the same county. And even as long as that home is not more expensive or more valuable than the one that they're transferring the basis from at the time of the transfer. Let's go on to the next slide. I'd like to talk just a little bit about permitting. You know, land use permits are permits that are discretionary permits. They are things like parcel maps, conditional use permits, variances, alterations to historic structures. These are types of permits which have to go before governmental bodies and be evaluated. Maybe there's aesthetic criteria that comes into case, such as architectural review boards. And those types of permits are relatively difficult to obtain, but you need to get them if they're required. Building permits, on the other hand, are deemed to be generally ministerial. If you are proposing something that is consistent with the zoning and it is code compliant, then it should be issued without much difficulty. Obviously, it will have to go through some sort of a plan checking process to determine that it is, in fact, code compliant. People are always asking, well, do I need to get a building permit if I'm not adding square footage? And the answer is yes, you almost always need to get a building permit if you're making an exterior modification to a building or you're changing any type of plumbing or electrical. If you don't get permits, and this is the slide that I'm on right now, then it's possible that all the money that you spent and the work you did can never be permitted, and you would have to demolish it, which would, is something that is highly problematic. You can also have situations where the unpermitted work caused a problem because there was a plumbing failure or an electrical fire that would normally be covered by your homeowner's insurance policy. But if the homeowner's insurance provider determines that there was work done without permits that would have required permits, then they won't cover that claim. Next slide. And I think I'm just about out of time.
That was your last slide.
Okay. So take it away, Tiffany.
Okay. Hi, I'm Tiffany. So I'm going to go through itemized deductions very quickly. This is not a class on itemized deductions, so I'm kind of going to move quickly through it. Once you've bought this real estate and, in this scenario, it's your primary residence, we're going to talk about how that can help you tax-wise. So standard deductions are what everybody gets on their tax return. If you're married filing joint, you get $27,700. Next year, it'll be $29,000. Single, slightly less. There's a little bit of an increase if you're over 65. These are what the standard deductions are. Everyone gets those. Itemized deductions are this fancy page that we see that some people don't even use. So medical and dental expenses, they're limited by 7.5% of your adjusted gross income. So if you had $1,000 a month in medical expenses, you get $12,000. your adjusted gross income's 150,000. That first $11,250 is not deductible on your tax return. So only 750 is deductible. If we go back to this slide, you can see in this example, they've got 195,000 is their income. This 6,000 in expenses is not higher than the limitation of 14,000. So they have a big zero on this slide, which is common. Taxes, this is the big controversial issue, the SALT limitation. It's limited to 10,000. If you married filing separately, it's even limited to 5,000. So, we see you had your withholding, your estimated payments of just under 9,000, your real estate taxes just under 5,000, some DMV fees, all that's just limited to 10. So you've got a big 10 on there. Interest, this is what we're talking about right now. This loan you might take out on your home. Pre-2017, it was limited to $1 million. Post-2017, it's 750,000. So, you take out a $500,000 loan, 5% interest. That's $25,000 of mortgage interest. That's what's deductible on those itemized deductions. Cash gifts, slightly limited. Stock gifts are even more limited to your adjusted gross income. So you can't give more than you made in a year. It just carries forward. Casualty and theft losses, again, those are also repealed as of 2018, unless a special circumstance. Santa Barbara, we're all familiar with the Thomas Fire. That was one of those special circumstances. And then job expenses, those are all these little guys down here. They're just gone as of 2018. So let's look at this, what it would look like. In our example, we talked about your married filing joint. You've got this standard deduction of 27,700. You made about 195,000 that year. That puts you in the 24% tax bracket. So medical expenses, you don't get any benefit from those. Taxes paid, limited to 10,000. We're saying we don't have a house right now. We don't have any mortgage interest. Let's say you gave 5,000 to the museum. So you've got this $15,000 itemized deduction. So you have zero federal tax savings. That's because you already get this 27,700. So you're not having any additional savings. You get that automatically. Let's say we add mortgage interest to this scenario. You bought a house, you've got some mortgage interest to add. Again, no deduction for medical, limited to 10,000 on the taxes. So now we've added the 20. So now our total is 35,000. This is now going to give you a benefit for every $1,000 above the 27,700. It's in the 24% tax bracket. It's your tax rate. So for every 1,000, you're going to save about $240. And, people ask, well, is it the mortgage that's helping me? Is it the additional gifts that's helping me? Is it the medical expenses? And the answer is all of the above. It's the combination that helps you. So if in your scenario, you already have a mortgage, you're not trying to pay it off, then yeah, adding charitable deductions is going to help you. If you have the option to have a mortgage or not have a mortgage, this is how it's going to help you. So if we skip to the next example, let's say we decided to give a little more charitably. Well, now we're saving $2,900. In this example, we now have more medical expenses. The breadwinner of the family's got themselves on their medical insurance, but the spouse, the kids, that's $1,500 a month. We've now got 18,000. It's really easy to have 18,000 medical expenses these days, but the first 14,000 is not deductible. So this deduction's actually only going to be 3,700. So the savings actually is close to that as well. So it's 3,375 is the difference between 14,625 and 18. So the savings is going to be this 37. So then you have the opportunity. Well, what happens if I paid off my mortgage? Yay, I paid off my mortgage, you guys. Well, all that did in this tax scenario is you now have no benefit for any of these medical deductions or any of these charitable deductions. You're getting 27,700. You're still getting that, but you got it anyways. And so you're receiving no additional federal tax savings. And all of these are just federal tax. So there is an additional savings for California or any other states as well, but federally, we're just sticking with that right now. If you were to increase your mortgage, let's suppose, interest rates are higher. Should I get into the market even though interest rates are higher? Well, $25,000, you're now saving almost $5,000 in federal tax savings. I have people ask me all the time, should I pay off my mortgage? I got an RSU from my stock from my company. Should I pay it off? And the question I have is, what else can you do with that $500,000? Can you, especially if you have an older interest rate, if you have an interest rate that's, 3 or 4 or 2%, that's a commodity in and of itself. You want to hang on to that. And you could leverage that $500,000 and invest it somewhere else. If you want to, you're preparing for, the closure of your estate, you're preparing for your own passing. Do you want to pay off your mortgage for your kids? I don't give investment advice, but I would say don't, invest it in something. At $500,000, there's an investment advisor that's going to do a great job for you. They're going to have great rates. That's a good chunk of money. Invest it and let the kids decide if they want to pay it off, or get life insurance that covers just that, mortgage value, just like we do when you're young with young kids like myself. I've got a life insurance that covers the mortgage so that if I pass, my husband doesn't have to worry about the mortgage with the kids. Get one of those, but don't be so quick to just pay off that mortgage, especially if you've got a really, really good interest rate. So let's talk about what it means tax-wise to buy this house and own this house. Your basis is the purchase price. This is what you paid for it, plus any improvements. So you fixed up the kitchen, you replaced the windows, whatever you did, all of that adds to your basis. Capital gains is your new selling price minus that basis. It's really important to remember that whatever your mortgage is doing has nothing to do with your capital gains and your basis. That's just an additional piece. It just means that the sales proceeds is going to go to pay the mortgage company and then whoever owns the house. It has nothing to do with the tax capital gains. Selling expenses, though, things like the commission, the escrow fees, those do add to your basis. So I'm using older numbers because the new real estate market is insane right now. 2012, we bought a house for $500,000. Good job, us. We spent $50,000 replacing a kitchen when you still could spend that little to replace a kitchen. And then we sold it in 2020 before the craziness for $900,000. Selling expenses, I said, are 6%. That's about right. So our capital gains is going to be that 900 minus 500 minus 50 minus 54. So it would be $296,000. There's one other exclusion that we're allowed. It's called the 121 exclusion. For married filing joint, it's $500,000. For single people, it's $250,000. This is when you have lived in the house for 2 of the last 5 years. So in this scenario, a single person would have a $46,000 gain, not too bad. Married people you wouldn't actually have a loss. So on your primary residence, you don't get a loss. It's just limited to 0. So you would have 0 capital gains on the sale of this home. That's great. That's your personal residence. So let's say we don't buy it as a personal residence. Let's buy it. Let's make it a rental. Cash flow is easy. Money came in, money went out. The difference, that's your cash flow. That's the money in your hands. Taxable income is different. It does not include those principal payments on the mortgage. It only includes the interest expense. And it does include depreciation. So depreciation is the value of the building. So typically it's a 60-40 split. You can look at the appraisal, you can look at the property tax statement to see if it really is 60-40. Sometimes it's less with a condo because there isn't really any land, but land is valuable. It's 40% typically. You divide that by 27.5, that's the tax code, 39 years on commercial. So if we bought an $800,000 property, we can depreciate it about $17,500 per year. So these are the calculations right here if you want to figure out. So cash flow, this is my broad example. We're saying an $800,000 home, we put 20% down. This is what 6% interest is. This is your payments annually on 6% interest of $640. Property taxes on an $800,000 home is about 10 grand. I just threw in some like $750 for insurance. Maybe you spend $500 in legal and accounting fees, little couple repairs here and there. So this is roughly what your expenses are going to be in that first year. And hey, you broke even. That's pretty good in your first year owning a rental. Tax-wise, on your tax return, we don't get to include the mortgage principal payments that we made, but we do get to add this depreciation. So tax-wise, we have about $9,500 of losses. Now, in the rare scenario that you were able to purchase this rental and still made less than $150,000 a year, there is a special tax code that allows you to deduct up to $25,000 to offset your ordinary income, like your W-2. But I'm assuming if you qualified for this $800,000 property, you probably make more than that. So in this scenario, that $9,500 just carries forward indefinitely to a future year, because eventually this mortgage interest is going to go down. It's only amortized over 30 years. And this depreciation you only get for 27.5 years, then it's zero. So eventually you'll have some tax income. But let's just look at the next 5 years. So I said 3% increase on rental income. And this is the beauty of a rental. Your largest expenses are fairly fixed. These payments amounts are not going to change. They'll kind of switch so that you're paying more principal and less interest, but they stay the same unless you refinance. And the real estate only goes up 1% per year, whereas 3% per year is pretty conservative on a rental. I would challenge you to find an $800,000 house that's going for $5,500 a month as a rental right now. So that means that after 5 years, you're making $8,000 a year in income. Tax-wise, you can see the mortgage interest went down a little bit. This went up a little bit, but we're still making about $430 a year on our taxes. But we still have all that $9,500 from the first year and the little bits from the previous years to offset this income. So that's very, very helpful. Let's see. Oh, that was the end of my talk for real estate taxes. So, whether or not you want to buy the house as a personal residence, it'll help your itemized deductions, or if you buy the house as a rental, this is kind of like a brief overview of what that looks like on your tax return. Let's jump to our questions. Andrea, do you want to facilitate those?
Yes, hi. Chris, Tiffany, thank you guys so much. What helpful information. You touched on this a little bit, Tiffany, but I bet Chris will probably have a bit more to add as well. What happens if you have a mortgage and your children inherit the home? And is it better to pay off the mortgage before you pass or have them inherit the property free and clear with no mortgage?
Am I unmuted? Yes. Well, the first thing that you'd have to do is take a look at the mortgage itself and see if it has a provision which deals with that situation. And it may also depend on the vesting of the property, but generally I would think that it would be better for the children to inherit the house with the existing mortgage. And I think that there are state and federal laws which preclude a lender from calling the mortgage due because of the transfer to the children. So if it's a transfer that's made as part of an estate distribution, I think the mortgage can stand, and the due on sale or acceleration clause that is contained within the mortgage would not be exercised by the lender. Hope that helps.
Tiffany, do you have anything you want to add to that?
I mean, when you're looking at an estate, you want to see what else is in it. So, if there's stocks that could potentially pay off the mortgage, when someone passes, then that can be their option. As Chris said, if the loan is assumable, then great. If it's not, you want to make sure you have other options in play, like I had mentioned, life insurance, or even just having stocks that can be sold to pay it off is an option. But I would not rush to pay off that mortgage. I would plan that out and really look at what your options are.
And then there's a few other related questions in the chat. Does this only apply to parents/grandparents transferring to children and not uncles, aunts transferring to niece or nephew?
There are two different questions that are sort of bundled there. There is the parent-child transfer, and that only applies between parents and children. The children can be adopted children, provided the adoption is just, is a true adoption, and it's not an attempt to get around the reassessment provision. So there's the parent-child exclusion from reassessment. And as we discussed, it's limited to $1 million now. And then there is also something that's called the grandparent-grandchild exclusion. And that would be a transfer from grandparents to children, grandchildren. But for that one to work, the parents have to be deceased. So it's sort of it has to have this generation skipping aspect to it. And again, it's limited to $1 million.
Okay. And again, another kind of subset of that question. What if you leave your home to your two children in equal parts, but only one of them plans to live in the house?
That is an open question. That's I think that it would probably qualify, but you'd probably want to consult with somebody who's an expert in that area and figure out how to structure it so that both of the children would have equal ownership, occupancy rights, but one of the children, the one that's not living there, is probably paying rent or doing something like that.
Here's another. Is there a way to hold property so that children can inherit it without reassessing for property taxes by the county? You want to jump in there, Tiffany? You're on mute.
No. It used to be, I've seen people, I worked at a law firm for a long time, and people would put them in LLCs and then transfer the LLC interest that wouldn't trigger the property tax assessor. But that's the funny thing about the property tax assessor. If you get away with it for a couple years, they don't mind. They just come back and assess back taxes. If you did it incorrectly, once 50% of that ownership has switched, it's going to get reassessed. They have now limited it to these very minute exceptions to do that, because I could go on about this forever. My husband works at the city, and this property taxes is what pays for the roads that he's designing for you guys. So, they like it. It's steady stream. They want it to be, it's not like income tax or sales tax that we don't know what it's going to be from year to year. Cities like real estate taxes. They've found a way to keep them up. Sorry, there's no good answer.
Okay.
And there definitely are people that still try LLC sort of structures to avoid reassessment. But a lot of those are probably kind of audit risk types transactions where, as Tiffany said, they work until you get audited, but once you get audited, they would probably collapse.
They just catch up the back taxes for you.
My mother's estate has a home that I live in now. Can the transfer be part of an estate distribution now?
The term that you're looking for is not estate distribution. So it can be it would be a gift tax distribution, and it would use up part of their lifetime exemption. But you really want to look at this closely because when she passes, you get what's called a step up in basis. So if she bought that house for $20,000, it's worth $2 million now. You know, when she passes, you get that step up in basis. It'll be worth $2 million when it goes to you at her passing. If you do it now and it goes to you, your basis is going to be $20,000. And when you sell it, you know, you want to move to Texas or something, you're going to pay capital gains tax on, you know, $2 million practically. So plan that well. Work with your estate planner to really look at that.
How long can you leave the house in the name of a deceased parent's trust before you have to change title?
Till the estate's settled. What do you think, Chris?
Yeah, I don't, you know, I think that most people want to figure out how to distribute from a trust as soon as possible. But, you know, there are some difficult assets because there really is no market for them. I know that I have something like that where my father had something called a TIC, and it's a tenants in common agreement, tenants in common ownership of real estate, and there's no market for that. So, you know, if it has any value, which it may not, we don't know, but we can't distribute it because you know, it doesn't really have any value, and it's in a Delaware LLC, and you can't break that apart. So it's
Well, and I'll add that, you know, if you're feeling rushed, I do a lot of estate tax returns, and you know, those take minimum 2 years to wrap up. It's 9 months to filing, 6 months extension. You got 15 months just to file that tax return. It usually takes about 2 years to wrap everything up. So 2 years is a very reasonable amount of time to have it in there. 3, 4 is okay, but you know, if it's just like a house and you're trying to like not have the county assessor reassess it, I just don't, it's not going to work. It's one of those, like, you can do it, but it's a huge audit risk because it's not accurate.
And
It's
you
not
get
proper.
the reassessed back taxes anyway, right?
Yeah, they just come back and
Yeah.
let you know what you missed.
All right, I love this one. Please talk about donating a piece of property to a charity. What should one do in advance to maximize the tax advantages?
Well, as we talked about basis and things, when you donate to a charity like the museum, they don't pay capital gains tax. So you want to donate something that has, you know, if you have a choice of what to donate, you definitely want to donate the item that has the lowest basis. So your lowest purchase price, you've put in the least amount of effort into that. And then you donate it to the charity, and then the charity does the selling and taking care of that. I wouldn't say that there's anything necessarily specific that you need to do to the property, but you want to donate the property, not, you don't want to sell the property and donate the proceeds, if that makes sense. Would you add anything to that, Chris?
no, I don't know if you want to get into charitable remainder trusts or anything like that.
You can put it into a trust if you want to donate something that you know, you have a rental property and you want to give it to the museum, but you want to live on the income while you're alive or while your surviving spouse is alive, you put it into a charitable remainder trust so that you get the income while you or your spouse, whoever you designate, is alive. They get that rental income. And when they pass, the principal, the physical property, will then go to the museum, but you get to take advantage of that tax deduction in the year that you form the trust. So, you know, if you've got a big restricted stock coming or you're selling something, a business or whatever, and you have a big gain coming through, that's a good year to set that up for the future. So you still maintain the privileges of that rental while you're still alive or while your surviving spouse is still alive.
Last question, and I know there are so many more in the chat, so I highly encourage you to reach out to Tiffany, Chris, or myself to help answer any of your questions. But last one, how do I fund my house into my trust?
Well, it's generally a very simple process. Well, first of all, you have to have the trust created. And then you use either you could use a quitclaim deed. We usually use a grant deed where you convey your property to yourself as trustee of your trust. And that is not a change of ownership for purposes of reassessment.
And what's the importance of doing that, Chris?
Well, the importance of doing that, and the importance, and one of the primary reasons that people use revocable trusts is to avoid probate. So with a trust, you can control the destiny of your estate yourself, and it can all happen administratively and without any sort of court oversight, such as would be the case with a probated action, where you would have a will that needed to be probated. So revocable trusts are really good things. They're very important. They have that probate avoidance aspect to them that is really fabulous.
Thank you. Thank you both so much again. We really appreciate your time and expertise. And our contact information is there for any additional questions, or if you'd like to talk with us about your specific needs. I think all of us are thinking more about how to make the most of our real estate in our estate plans, as wealth planning and estate planning really do go hand in hand. As you consider your estate plan, I hope you might consider adding the museum. I am available to help with any legacy giving questions you might have on how to do that. The museum's Planned Giving Advisory Council is hosting our free estate planning awareness workshop on Sunday, November 17th from 2 to 4 p.m. with a reception following with estate planning professionals from 4 to 5. An estate plan is essential to ensure your wishes are honored, your family is protected, and your assets are managed according to your wishes. We encourage you and your loved ones to attend, whether you're creating your first estate plan or need to update yours. Tiffany will be one of our featured speakers that afternoon, so hopefully you will come and join us. Again, thank you, Chris and Tiffany, and thank you to the museum's Planned Giving Advisory Council for helping to coordinate the presentation. And thank you to all the attendees. This was our largest Lunch and Learn to date, and we are so glad you joined us for this community benefit. Have a great day. Again, thanks all.